All right, I got 10:30, so let's get to rolling, guys. Appreciate you joining in today. I know I'm going to go ahead and mute all of you guys. There should be, just so we don't get feedback from your ends, and there should be a way for you to click on the unmute button there if you'd like and to chime in. So I hope to hear from you and have some interaction and get some questions answered. I've had several folks that have asked if we'll record this as well, because I know there's folks that want to know about it, but weren't able to be on the call today. Let's roll. Livestock risk protection. This is something that I've used and something I've found is a good tool for your toolbox in terms of your whole marketing plan, risk management plan, and things you might want to look at. So it's essentially a price insurance product, and there's some confusion to it, but as far as all the different risk protection things go, I think it's one of the simpler ones to use. So let's jump into some facts on it here. It is a price insurance for cattle. So you're essentially buying an insurance product that protects against downward movement of price in cattle. It is based on a regional average for the type of cattle that you choose and for the end date that you pick. So that's one of the confusing parts about it is people say, well, you're not buying insurance on your cattle. You're buying insurance on a regional price average for cattle in the area that you pick and for the end date that you pick. The understanding is that if this regional average for these cattle moves downward, so would your cattle. So if everybody else is getting $1.50 and you usually sell yours for $1.70, then you have a 20-cent advantage over the regional market. Well, if the regional market moves to $1.30, then maybe yours would sell for $1.50. Okay, so even though your cattle may not be directly tied to this in terms of price, they are likely connected to this. So you're ensuring some of that price movement. Okay, if people are familiar with some different risk management tools, such as forward contracting, buying contracts, or put options. This is similar to a put option. And a put option, what you do is you're buying a minimum price, and then you're allowing any upside movement in the market, you can still participate, okay? And that's what this does as well. So it's similar to a put option, but the premium is subsidized 13%. Okay, so the federal government is interested in ranchers managing their market risk. So the federal government said, hey, we're willing to subsidize this product by, and their point was 13%. Another thing about this different from a put option, when you buy put options, you have to buy in 50,000 pound lots. So you're buying load lots in terms of put options. So for ranchers that operate at a smaller scale, this works better because you're buying in 100-pound increments and not in 50,000 pound units. So it works better for those smaller scale, but I also think it's a little easier to understand, and the fact that it's subsidized 13%, there's a little bit of advantage of that as well. Again, this product protects downward price movement and it leaves the upside open. So let's say we bought insurance today. If the price tanked between now and when you sold your calves in the fall, you're going to have some insurance. You're going to have some protection on that. If the price went up, so let's say we jump back up to $2.50 calves, well, you're still going to be able to participate in that. You won't, your premium that you pay would be gone, but you'd still be able to sell your calves at the higher price. If you forward contracted your calves today for fall delivery and the price went up, you're locked in at that price you forward contracted for. Okay, so a contract locks you in. It protects you against downside, but it also takes you out of upside movement. Put options, or this product, protect against downside movement, but they leave the upside open, if that makes sense. So let's look into it. I want to run through a couple of examples, and then I want to spend some more time talking about how this product works and helping you understand how to use it. Before I do that, I want to check in. Can somebody use the chat box, and am I coming through? Is this all working okay? Or unmute themselves and let me know.
Yeah, Dallas, it sounds fine on our end.
All right, thanks, Matthew. All right, let's keep rolling then. Okay, so example number one. I want to look at, I'm going to go back in time on this first example. And the second one, we're going to do one current in time. Okay, I want to go back to June 2nd of 2016. Okay, on June 2nd of 2016, I wanted to insure 150 steer calves that were going to weigh about 500 pounds for a late October delivery. Okay, so I want to go onto the website and show you how you would pull off what you could buy for the price insurance product, what it would cost, and then since we're using a historical example, we can see how it would have played out for that time in June. Okay, so I'm actually going to bring up my internet, and I'm going to look this up. I always just Google LRP. That's the name of the product, and it's sold by RMA. Okay, so if you want to write something down, if you want to find this website, just Google those three letters: LRP, RMA. Okay, if I type those in Google, I get these two links. Okay, I'm actually going to go to the second one first because I want to show you some resources that are there. So USDA Risk Management Agency is the agency that sells that has the product. Crop insurance agents sell it. So if I go on here, scroll down to the bottom, here's the information for livestock risk protection. Okay, here's the resources I wanted to show you. First of all, there's a training video that goes into a lot more detail than I'm going to go into today about the product, how it worked. There's a fact sheet on LRP for feeder cattle, which is what I assume most of you are interested in. So you can read that, get more information on how the product works. The thing we're going to go to is coverage prices, rates, and actual ending values. Okay, this is where you get price quotes for how much it costs. This is where you get what you can buy for. Okay, so I'm going to click on that. And then I'm going to click on LRP. That's the one I'm interested in. And then we're going to walk through this essential worksheet here and get it. June, I forgot the date I said now. June 2nd, I think. Let me go back, check it. June 2nd, okay. So we're going to go into June 2nd. So I'm going to go clear back here into 2016, June 2nd. Okay. Once I got my date, I hit next. And then I'm going to do it for Wyoming. Okay. I'm interested in feeder cattle. Okay. Now type, this is going to take a little bit of explaining. Steers weight 1 and steers weight 2. Weight 1 is under 600 pounds. Weight 2 is between 600 and 900 pounds. Okay. So since I'm interested in a 5-weight steer, I'm going to choose steers weight 1. All right. So on June 2nd, here are the products that they were offering. Okay. So what I did there is just essentially show you how to look up what is for sale and how you can buy it. Now, since we're looking up in the past, this last one here, actual ending value, has been filled in. If we were looking up today's prices, these actual ending values would not be filled in because we don't know how it's going to end. Okay. But you see back here on June 2nd, 2016, I could have bought a policy for steers weight 1 that ends October 27th. Okay, so the offerings, how long this chart is, these offerings, this varies. What I've tend to notice is between Tuesday and Thursday, there tends to be a lot of offerings. The offerings are posted at 3 p.m. Mountain Time in the afternoon, so you have to come in and check on it about that time and see what's available for sale. On this particular date, they offered a contract ending date of September 1st, September 29th, or the end of October, and then they offered different coverage levels at that. Okay, so we're going to spend a little time looking at this chart and understanding this chart. I'm going to go back into my PowerPoint. I just wanted to show you how you get to that. All right, so here's what we have. This is the chart we just looked up. I just threw it here into the PowerPoint. So let's look across this chart and see if and make sure we understand it. Okay, so this is all for those steers weight 1. These are things that were for sale back in June of 2016. Now, as we looked at expecting ending values, this is what the futures market thought those cattle would be worth on these dates. Okay, so this back in June, the futures price said, we think in September 1st, feeder cattle in this region of this weight class are going to be worth $1.60. Okay. If we went out to the end of September, the futures price said, we think they're going to be worth $1.59, $1 a hundredweight less. If we went out into October, the futures price thought it would be worth $1.58, and so on and so forth. The next column here, coverage price. This is what you're buying the insurance to protect, okay? And to get the coverage price, we look at the coverage level. So here on this first offering, they're selling you 96% of the expected ending value. Okay, so they're going to say, we expect them to be worth $1.60 with the futures price. We're going to sell you insurance for $1.54. So you're buying insurance at 96% of the expected ending value. Okay, that makes a little more sense as we look down here onto October 27th, because there's 3 offerings for that date of these steer calves. Okay, you notice the first one is at 98%, the second one is at 96%, and the third one is at 90%. So we're buying insurance for, they think they're going to be worth $1.58, and you see that's the same price all the way down through on the end of October. We can buy insurance for $1.56, $1.51, or $1.43. Obviously, the higher we protect, the more the insurance is going to cost us. So you can essentially decide how much money do I want to lay out and how much insurance do I want to buy. It's very similar to thinking about your auto insurance. What deductible do I want to insure with? Okay, same kind of concept. So let's say for this example, we want to buy this highest insurance for the end of October. We want to get the Cadillac policy. We're going to insure 98% of the expecting ending value. We go to the next column, and that tells us what it costs. Cost per CWT, or per hundredweight. It's going to cost us $7.56 per hundredweight. Okay, so if I'm protecting a 5-weight steer, I multiply that number by 5. Okay, now let's work through this a little bit. I've put in some helpers here to do it. Okay, so we're going to buy this one, $1.56. $1.56 times our 5-weight steer means we're going to buy insurance that these 5-weight steers, these regional average 5-weight steers, should be worth $781 a head the end of October, October 27th. Okay, so that's what we're buying insurance for. We're protecting that price. To do that, it's going to cost us $7.56 a hundredweight. Okay, $7.56 times 5 is $37.80 per head is our total premium. Okay, so that's where I got that number from. Okay. Now, here's something you need to know. It doesn't tell you this on the chart, and it doesn't tell you this very easy in the fact sheet. So this is something you need to pay attention to. We take that total premium, and remember I told you this is subsidized 13%, so I take that total premium, I multiply it by 0.87. Okay, I've essentially taken 13% off because that's the part the government's going to pay. I'm going to pay 87% of that premium. Okay, so that gives me a $32.89 is the producer premium. That's what I'm going to write my check for. Okay, the total premium is at $37. I'm responsible for $32.89 of that. Okay, so that's the number I really want to get to. So we take this number right here, calculate out our total premium, multiply it by 0.87. That gives me the amount that I'm responsible for. Okay. Here's something I always like to do to check that in. Let me clean that slide up. Is I take the $781 that my insured price that I protected, I subtract out my producer premium. Okay, so essentially what I'm saying is here's the opportunity for me to lock in a $748 calf. Okay, regional average for steer calves. Okay, so that's what I looked at in October of 2016. Okay, so back in July or June when I could have bought this, I would have thought, boy, is that a good idea or not? What's the market doing? What's my risk tolerance level? Well, since we did this one, we have the ability to look forward and see how it actually played out. So let's do that. Okay. So let's say we went ahead and bought this insurance. We protected the regional feeder cattle price of $781 for this 5-weight steer. It cost us $33 a head. I rounded here. Or if we bought the total for these 150 steer calves, I would have had to write a check for $5,000 when I walked into my insurance agent's office to buy this. Okay. The actual ending price on these steers was $670 a head on these regional average steers. They don't care what your cattle sold for. Okay, we're buying a regional average. So the regional average was $670 a head, or a difference of $111. Okay, So I bought the insurance at 781. When the whole game was done, the regional average came back in as $670 for those, or $111 a head. They wrote me a check for $16,650. Okay. So essentially, would I have been smart to buy this a year ago? Yeah, you bet I would have. Okay. Does it always work like that? No, it doesn't. Okay. So essentially, I wrote a check for $5,000. They wrote me a check for $16,000 on these 150 head. So it would have been smart last year to have put a floor on these cattle in June or whenever this insurance was. Let me stop there and open it up for questions on this first example.
So Dallas,
Yeah.
based on that scenario, what happens if you didn't sell your calves in that time period, even though that's the insurance product you selected? Let's say you bought your calves or you sold your calves at a different marketing window. Not a problem, right?
Good question. Not a problem. You still would have got the indemnity or the $111 or the $16,000. They still would have wrote you the check for that. You don't have to sell the calves when the insurance expires. Okay. But your calves would have been worth less. So you would have still had the hickey on the value of the calves, right? But just because you chose to not sell them the end of October, you still would have got the insurance payment.
When would they have had to have been sold, or do they even have to be sold?
They don't need to be sold. You could still own them today if you wanted to. There is a rule in the insurance that if you sell the cattle 30 days prior to the closing date of the insurance policy you bought, the insurance goes with the cattle. Okay. So if I'd have had a drought and I sold these cattle August 1st, after just having bought the insurance in June, the insurance goes with the cattle. So the person buying the cattle, I could sell them as, hey, I'm selling you these 150 steer calves. They come with an insurance policy. Okay. So that's the one we did. All right, here's an example from today. I had to back up to the 4th of May to find feeder cattle that were available on this. I mentioned that Tuesday through Thursday, they tend to come out with more options on this. Friday, they didn't have any feeder cattle offerings, and Monday, they didn't have any feeder cattle offerings. So I had to back up to the 4th of May to find one. But here's what you could have done on Thursday. Okay, if I want to do the same thing, I want to insure 150 steer calves that are going to be weighing about 500 pounds. The option on the 4th of May was to insure them to the end of September. Okay, so if I wanted to do that, here's the chart that would have popped up. We would have got to this exactly the same way I showed you earlier. Just click onto that link and walk through that. Notice here on the far right, I cut off the actual ending value. That column is blank because we don't know what the ending value is. Okay, but these were the offerings that they had. And I'm going to focus on, notice everything is the end of September. That's the only ending date that they were offering on that particular day. Okay. The expecting ending value, they think the futures market today, or then Thursday, thinks these cattle, these 5-weight cattle in Wyoming, are going to be worth around $1.72 the end of September. Okay, so I could buy insurance all the way up to $1.71, or if I wanted to cheapen it up, I could go all the way down here to $1.58. And it looks like through the scroll bars, there might even been some lower offerings. And you notice the cost per hundredweight, or the premium that I pay, goes down substantially as I insure those cattle for a lesser amount. Okay, I like the numbers I'm seeing at the topper end up here, so that's where I'm going to focus. Okay, is insuring them for the higher rate. I want a coverage price of $1.71 or $171 a hundredweight. That's the one I'm going to look at. Okay, so let's do the same thing with this one that we did with the previous ones. Okay, $1.71 times the 5-weight. I can essentially protect a regional average steer. The end of September will be worth $858 a head. Okay, again, I took that number, I multiplied it by the 5-weight steer I'm protecting, and I got to my $858. Here's probably a spot to say, if I wanted to protect 3-weight steers, I understand those 3-weight steers are probably going to be worth more than that per pound, but I only need to buy 300 units of this, okay? The idea is that these, as the 5 weights become worth more, so will the 3 weights. As they come down, so will they, okay? I'm not protecting a price slide in there, but I am, the relationship between the two of them I am protecting. Okay, so, but let's go back to this 5 weight. $171 or $171 times 5, I'm protecting $858 a head. It's going to cost me, this stuff's pretty expensive right now because there's volatility out there. It's going to cost me $11 a hundredweight to buy that insurance, okay? Or if I do it by the head, it's going to cost me $55 a head to buy that insurance. Actually, that's the total cost less the subsidy. It's going to cost me out of pocket $48 a head to buy that insurance. Okay. Now here's where we do the subtraction. The price that we're protecting minus our premium. Essentially, I've got the opportunity now to say $810 steers in the fall or the late September. Is that something that I want to guarantee, that I'm willing right now to pay $50 or $48 a head to guarantee that I'll have that those regional average steers will be worth $810 in the fall? Okay, to me that sounds like a pretty good deal right now, given the volatility of the market, given that the fundamentals of the market suggest things are, optimism is high right now and things are likely to trend downward. Okay, that's looking pretty good to me. The downside of it is I got to lay out $40 today. So if I've got cash flow issues, I don't like writing a check for $48 today to wait till fall to see if this thing plans out or not. Okay, but those are the options as they sit today. If you wanted to cheapen up the $48 today, you sure could, but your price insurance point is going to be quite a bit lower to do that. So do this subtraction here, and usually it becomes pretty clear that the higher end values are the better buy. Downside being cash flow. You got to come up with the money today. Okay, so there we go. That's the offerings that there are today. Let me run through some key points on this, and then I'll stop and open up for questions again. Okay, LRP insurance. Again, it's not based on what your calves bring. They don't care what your calves sell for. In this previous example, I'm protecting those calves. I'm protecting an $858 steer calf in the fall. My steer calves might sell for $1,000. If the protected price is below that, I still get a check for the indemnity. Vice versa could be true as well. If my steer calves always are at the bottom of the market, mine may not bring that. But if the regional average brings that, I won't get a check. Okay? It's not based on what our calves are bringing. And I already made this point when Matthew asked this question. If you sell 30 days prior to the end of the policy, the insurance goes with the calves. Okay? You don't have to sell when the policy expires. You can keep the cattle. You must have cattle to buy insurance. They don't want speculators playing in this market. So if I don't have the cattle on hand, I can't go out and buy an insurance policy for cattle that don't exist just to speculate in the market. They don't want you to do that. Okay. Here's a big point, guys, and ranchers constantly screw this up. Don't look at this as a profit maximizing strategy. Okay. I'm not buying this insurance to gamble and to say, well, if I buy it, I think I'm going to collect. Okay. Look at it like you do your car insurance. Okay. You don't buy your car insurance policy. Let's say you're going to write a 6-month premium for your car insurance. You don't write that check thinking, man, I sure hope I crash my car in 6 months so I get to collect a payment from the car insurance. Okay. But when you do write that, you think, well, if something really bad happens, I'm going to be able to, they're going to help me out. Okay. It's the same way to look at this. So we don't go into the insurance office and write the check hoping that we get to collect on this insurance. Okay. We write the check and think, man, if we really have a wreck, I'm going to be covered, but I hope I don't have to collect on this. I hope my calves sell for way more than I protected them for. Okay. That's the mindset to take into this. Let me show you an example. This is a insurance over time with made up data. So I just completely made up this line, but it's really the way things work. So in years, on the left side is total gross income from a ranch, and on the bottom side is years. So I don't have to tell you guys, we have years when cattle sell okay, we have years when we really do well and we feel good about things, and then we have some years where the market turns around and it's a complete disaster. Okay, so if all I did is I took my cattle and sold them October 1st at the sale barn every year, this might be what my income variation looks like over time, just based on the fluctuations in the market. Okay. If I use something like LRP insurance, okay, then my total returns are going to change over that time. Let's look at how it would play out. These first 2 years, if I bought insurance, okay, it doesn't look like a market wreck is happening to me. Okay. So I'm buying the insurance. I write my premium check. Let's say it cost me $5,000 to $10,000 a year to protect my calves. I don't collect an indemnity payment. Okay, the insurance doesn't pay out. So I made less each of those 2 years because I bought the insurance, right? Now this third year, okay, prices were good. The insurance offerings offered me higher prices. I bought the insurance. Prices moved down. Well, what happened that year? Okay, I collected a payment. Okay, yeah, they wrote me a payment for a difference that paid my premium plus some. So I actually made more money in that third year by buying the insurance. Okay. Fourth year, what do you think happened? Prices moved down, but not drastically. Maybe I got an indemnity that just covered my insurance premium. Okay, so I was no better off, but I wasn't also worse off by having the insurance. What happened this next year? Okay, boy, it looks like a price wreck. Okay, having the insurance made a big difference that year. Okay. So what this does is it takes the lows out of the lows. Okay, you give up some most years by carrying the insurance, but those years when you have a low, it takes the low out. Let's keep going with this. Okay, next year prices went up. I bought the insurance. I paid the premium. Didn't collect anything. Same as the next year. Oh, here comes another wreck. Well, guess what? My bottom wasn't near as low. Okay, now this next one's important to see. Prices were low. The insurance product is probably not going to let me protect very good prices. Okay, I bought the insurance in a down market year. Okay, I protected a low price. Prices stayed low, but they moved up a little bit. I was worse off by buying the insurance in that year. Okay, so those years, what the policy really helps is when prices are high and then they move low. That's when the insurance product pays. Okay, if prices are low and they move up and they stay low, you're still not going to get a check because you bought in the insurance when prices were low. Okay, the next year, again, prices were high. So here's what I said. This is not a profit maximizing strategy. Okay, here's what I mean by that. Now this is made up data, so it's not going to come out just quite right. But in theory, if we averaged our income across, that's 10 years of data, across all 10 years of data, and we were selling in the cash market, okay, there's where that line would be. If we averaged our prices with the LRP insurance, there's where our line would be. Okay, so on average, we made less money by using the LRP. Okay, but what did it do for us? It took those years, it took those low years out. Now, is that valuable to us? It depends. Okay, if I'm a rancher and I have $5 million in the bank, first of all, if I have $5 million in the bank, I'm probably not a rancher. Okay, but if I'm well capitalized, I've got money in the bank to withstand bad years, I probably shouldn't buy the insurance. Okay, if I'm a younger person or perhaps I'm newer to ranching and these bad years are going to maybe put me out of business, I sure as heck better have something that's protecting me against market swings. Okay, so this year right here could have meant the end for that ranch. Okay, that might have meant that they went broke and they went out of business. So having the insurance could have meant a make or break for them. So it takes those low years out of the low. Okay, again, it's not a profit maximizing strategy. It's probably not going to make me more money over the long time, but it is going to help me out in those years when prices are really tough. Okay. So that's the main point I want to make with that. And that's one big point I want to leave you with on this whole webinar, is that it's not that. Here's where I think it is useful. Okay, if I know my cost of production, let's say my cost of production, my break-even price is right where that line is. Okay, it sure makes me sleep good at night to lock in a profit. So if I can insure my calves above what my cost of production is, then I know I'm going to do okay this year. Okay, and that's what helps me sleep well. Okay, down here on this bottom end, I wasn't able to do that. Prices were down in the tank. I was not able to lock in a profit on those calves, but I was able to minimize my loss. Okay, and to say, well, I want to just make sure I don't lose any more than that. So I think it really it's really a part of a component when you know your cost of production. You can say, yeah, I can lock in these calves at $850 today. I'm going to go ahead and do that. And then if the market moves down, I won't be the one losing sleep at night, knowing that that we might have to close the doors on the ranch. Okay, so that's the point of it. It's an excellent product for those who want to protect downside risk in the cattle market, people that are more risk averse, people like me. Okay, when I go out and buy stocker calves and I take $60,000 out of my savings and I go out and buy a load of stocker calves, I don't want those cattle to be worth $30,000 at the end of the season. Okay, so I'm more risk averse. I like buying the insurance product so I know I'll keep my money together. Okay. Or those whose leverage position requires a risk-averse attitude. Okay, let's go back up here. If I'm this young rancher and on this year right here, I'm leveraged into the bank, I got to make a lease payment, I got to make a payment on my cattle, I've got to meet these obligations or I'm going to go out of business. Okay, this product makes a lot of sense for people in that position. Doesn't make a lot of sense for the guy with $5 million in the bank who could withstand that bad year. Okay. So for those whose leverage position requires a risk-averse attitude, okay, don't look at this as a profit maximizing strategy. Okay, how many times do I need to say that? I think I've probably said it enough. You got it, Blake? All right. I see you nodding. Okay, rather it's a loss minimization strategy. Okay, know your cost of production, your profit targets, and protect a price that meets your needs. Okay, there we go. That's the main points I wanted to make, guys. So I'm interested in your questions. I'll stop talking and take yourselves off mute and let's interact some.
A lot of volatility, or there has been in the last 10 days. If you follow this, are there opportunities now to lock in a price if your perception is this fall prices are going to be potentially lower, somewhere in the neighborhood of what they were last year? I mean, if you're aware of volatility in the market, is it a good time to be looking at this?
Yes, I think now is an outstanding time to be looking at this. The prices that I showed from Thursday, I think things have been pretty volatile since Thursday. I think they moved down Friday. I didn't see what they did yesterday. You might not be able to get exactly that price that I showed, but I bet you're still able to come right around that $800 mark on a 5-weight steer calf this fall. And I think if a guy can lock in a floor somewhere around there for 2017, I think you'd be really smart to do it. Blake, I heard you talking there. So let's go to Blake and then we'll come back to Matthew if he has a follow-up to that one.
Well, I was just wondering, like comparing this to other risk management strategies, and maybe you kind of touched on it earlier, but like put options and stuff. I mean, how are you kind of weighing like both those different risk management strategies, or, what are some things that you're thinking about, I guess, like this time of year?
Sure. To be honest, Blake, I haven't used those other tools very much. I have used this. As I've looked into it and read on it, this is really just in essence a subsidized put option. And the economists would say LRP should be a component of your risk management profile. Okay, and you should be using these other tools as well. To me, though, the other ones get pretty complicated, and I'm not a very smart person, so I get confused pretty quick by them. I can understand this one, and so I tend to use this one. And I like the fact, too, that somebody else is paying 13% of my premium. So,
right, yeah.
Matthew, did you have a follow-up to the previous one?
Yeah, two. So I know you indicated you have to have livestock. What proof is required to evidence of ownership?
You sign a paper saying that you have the animals. I'm guessing, like all government programs, there's a percentage of these that are spot checked. So somebody actually could show up and count, but I'm guessing it's a pretty small percentage.
Okay. And the only other question, so you just go to your local insurance agent that you're aware offers this, select the product that you want to utilize, and then when you select that and you buy the policy, you write the insurance agent a check at that time, or is there like a cleanup period, or how does the actual mechanic work?
That's all correct. What you just said is absolutely spot on. On that same website I was showing you guys, there's a spot where you could click to find an insurance agent. You put in your zip code, you put in that you're interested in livestock products, and it'll give you a list of people in your area that can sell it. My experience has been a lot of the insurance agents around here don't sell very much of this. Farmers use a lot of crop insurance. Ranchers aren't in the habit of using insurance, so they don't sell very much of it. If you come in as an informed consumer and say, I want to buy this product that ends on this period, they'll be able to sell it to you. And yes, just like you said, you fill out an application. That application just shows that you're an eligible producer to buy it, and then you start watching these offerings. And what I had to do when I bought it is I set an alarm on my phone every day at 3 o'clock to remind me to go on this website and see what was for sale. The day I found the one I liked that matched the selling period that I had in mind and was offering me the protection that I liked, I called them up at 3 o'clock in the afternoon and said, here's what I want to buy. Here's how many units I want. They said, great, come in the morning and write me a check. And so I went in the next morning and wrote them a check for the premium. And then it pretty much happens automatically at the ending date of the policy. If you're due an indemnity, you get a check in the mail. Let's check in with Nancy and Ricky. Anything from you guys? Questions coming up?
Dallas, we don't even have calves on the ground yet. We calve in June. So could I still insure those June calves knowing that they're going to be 200, 250 pounds for that September deadline?
Okay, so my original answer to Ricky was, I don't know. Since we did the webinar, I've looked it up, and the answer is the calves do have to be born before you're allowed to buy the insurance on them. You can buy the insurance the day that they are born, but they do have to be born before they're eligible to insure.
That's all right. And I kind of discussed briefly there that, let's say that was the case. Let's say I could insure those calves now for that September deadline, and the market drops. Great. I get cut a check on 250-pound calves. Then I can turn around, and because typically we would market them January, February, there's enough of a time frame there, I could reinsure those same calves.
Correct. You could, once that other policy has expired, so let's say you bought it for the end of September, October 1, you could buy another insurance policy on them for the January, February time. Now the things, the prices that you buy are going to be based on what the knowledge is in that October 1 deadline. So it might be a totally different market. If you watched this as well, I mean, I've seen policies that are even being sold today that go out to the January, February time. So if you keep watching it, there'll be some that are going to go out much further than that September date that I showed you. So that might be the better option for you, would be to go ahead and protect those out a little further and just do it once if you know you're going to hold on to them till then.
Okay.
Is the policy assignable?
I don't understand the question.
So like crop insurance, can a lender take an assignment of the policy though, so that when the indemnity check is cut, it's made payable to the owner and the lender?
I don't know. Might be something worth looking into.
Sure.
I know when I've bought stocker calves before and I told my lender I was going to buy this policy, that seemed to please them. But I don't know if they didn't ask to be made the payee of it. All right, so I also looked this one up, and the information I'm finding is yes, it is assignable to a lender. Any other questions, guys? All right. Well, thanks. I appreciate you guys joining in on this, and hopefully this has been useful for some people. I think it's a tool worth putting in your toolbox. So a little bit of shameless promotion here. We are recruiting for the Ranch Practicum School. Most of you on the phone have either been through it or have good knowledge of it. And this year we're further along in our recruitment efforts than we've ever been. We're 3/4 of the way full right now, but we do have room for about another 10 participants. So we'll be taking those. We start the end of June and we'll run through November. 8 full days looking at all things related to ranch management, production, forage, economics, and people. There's our website that has all the registration details and all that on there. So if you'd like to look into that or know some friends that would benefit from it, please refer them. And there's my contact information. So thanks for getting on today. Appreciate your time. Hopefully this has been useful. And I think it's a tool that if I was in cattle ownership business right now, I'd be taking advantage of it.